Welcome to the Deep Dive. We're your source for really cutting through the noise around earnings calls and big business stories.
That's right.
Today, we are diving deep into a major industrial player. They just announced their Q2 2025 results. So this deep dive is really for you, whether you're prepping for a meeting, maybe just keeping up with the sector, or looking for those crucial insights.
Exactly. And we're going to distill the core facts, the management commentary from their call. It was pre-market, August 1st.
Right.
Our goal, cut through the clutter, find the big takeaways, and understand the market's really surprising reaction. Because on the surface, it looked like a pretty solid quarter.
It did, didn't it? Okay, let's get right into the numbers then. Snapshot time.
Lay it out.
So the company reported a GAAP diluted EPS that showed a net loss of $0.29.
Right, which translates to about $115 million net loss, GAAP basis.
Yeah, standard accounting rules. But the non-GAAP, the adjusted EPS, that's often a clearer operational picture, right?
Absolutely. And that came in exactly in line with consensus, $0.80.
Okay, so a line there. What about the top line? Revenue.
That was a positive, $1.888 billion. That beat the $1.85 billion consensus.
Oh, okay. By about 2.1%.
Yeah, and up 5% year over year. So decent growth there. Adjusted EBITDA grew too.
Right, EBITDA. Always a key metric.
Up 3% year over year, $509 million. And the margin held strong at 27%.
27%. Pretty healthy. What about orders? Future pipeline?
Orders looked good, up 8% year over year, $1.94 billion.
Strong. And cash flow.
Free cash flow for the quarter was $210 million. They also flagged a strong liquidity, $3.9 billion.
It gives them flexibility.
Definitely. And importantly, the backlog grew, up 16% compared to the end of fiscal 24.
16% is quite a jump.
It is. So you look at all that, revenue beat, adjusted EPS in line, strong orders, growing backlog, solid margins.
That's pretty good, right?
You'd think so. But, and this is what's fascinating, the market's initial reaction was, well, cautious, even negative.
Okay, so that's the puzzle. There's more to the story.
Exactly. There's definitely a deeper story here beyond just those headline beats.
All right, let's unpack this then. Peel back the layers. Management, led by the CEO Vicente Reynal, they sounded pretty upbeat on the call.
They did. Quite confident.
They actually raised full-year guidance, revenue, EBITDA, EPS, all up.
Yeah, they highlighted the book-to-bill 1.06 times, meaning more orders coming in than going out.
Always a good sign. And that 16% backlog increase, they credited their IRX operating system for that agility.
Right. So connecting that to the outlook, the new FY25 guidance is for 4.6% revenue growth. Adjusted EBITDA between $2.1 and $2.16 billion.
Okay.
And adjusted EPS $3.34 to $3.46. All higher than before.
So management's raising targets, sounding confident. Why the market jitters? That's the core quote.
Precisely. Let's dig into their strategy. Part of it, they leaned heavily on their M&A flywheel concept.
Yes, the acquisitions. They're always doing deals.
They are 11 bolt-on deals closed just this year so far. Things like lead fluid pumps, TMIC compressors.
Smaller complementary buys.
Exactly. Adding about $200 million in annualized sales just from those. And they're not stopping.
Well,
They mentioned 8 more LOIs, letters of intent, in the pipeline. So the acquisition engine is still running hot.
wow. What is it, 70 deals in 5 years?
70 transactions. And they said about 90% were sole sourced, often from family-owned businesses, not big auctions.
So just have a good process, maybe better pricing.
A refined playbook, definitely. And they're focused on what they call the innovation pulse, especially in life science flow control.
Like that lead fluid deal.
Yeah, that broadens their pump offering into single-use bioprocessing. It helps them compete with bigger players, potentially with a lower cost base.
Smart positioning.
And they teased something interesting for late 2025, an AI-embedded compressor monitoring suite.
AI, adding intelligence.
Right. They expect this to significantly boost service attach rates, get them above the current 39%.
So more recurring revenue.
Yeah.
Less reliance on just selling the box.
Exactly. A long-term play for more stable income.
Okay, so strategy seems clear. How did it translate operationally? You mentioned the 27% EBIT margin held despite headwinds.
Yeah, held steady. They mentioned tariff headwinds, plus the dilutive effect of new, maybe lower margin acquisitions.
But they offset it.
They credited their pricing for tariffs playbook. Seems like solid execution managing those cost pressures.
Okay, solid execution. But there was a flag, wasn't there? The Goodwill impairment.
Ah, yes. That's a critical piece, and maybe part of the market's concern, $115 million non-cash goodwill impairment on ILC Dover.
Non-cash is important. Doesn't hit adjusted earnings or cash flow directly.
Correct. Management stressed that, and they've filed an insurance claim, but it does raise questions, about integration risk for a company that buys so many others.
Right. What caused the impairment specifically?
Well, they broke it down. Part was a write-down on a minority stake in a high-pressure solutions business tied to a weaker outlook for upstream oil and gas.
Okay, external market shift.
And then for ILC Dover itself, it was reduced expectations from a customer linked to a delayed next-gen space station project.
A specific project delay?
Yeah, plus just broader market inputs like higher discount rates affecting asset valuations. So a mix of factors.
Got it. Okay, moving to financial health, free cash flow. $210 million in Q2.
Right, down year over year, but they said that was mostly timing of bond interest payments. The year-to-date number is actually strong, up 13%.
Okay, timing noise then. And leverage, debt levels.
Improved. Net debt to EBITDA down to 1.7 turns. That's healthy. Gives them plenty of firepower for more M&A.
Which fits their strategy.
Exactly. And they're using cash for buybacks, too. $500 million in Q2, bought back 6.1 million shares.
Shows confidence in the stock price, around $81 on average.
And they plan another up to $250 million for the rest of the year.
Okay. Let's quickly touch on the segments. Industrial Technologies and Services, IT&S.
Orders there were up 7% year over year, book-to-bill 1.05. And importantly, this was the second straight quarter of positive organic order growth.
Suggests a turnaround is holding. Any specific areas?
Compressors up low single digits. But industrial vacuum and blowers were strong, up high teens, and they noted organic order growth in China.
China growth. That's interesting given the broader narrative.
Yeah, they framed it as team resilience and good demand generation efforts there.
Okay. And the O segment, Precision and Science Technologies, PST.
Orders up 13% overall, but that was largely M&A. Margins did improve sequentially, though.
Organic orders.
Down 5%. But they gave some color, excluding some big, lumpy orders from last year that weren't expected to repeat. Organic would have been up low single digits.
Okay, so maybe not as bad as the headline suggests. Any product highlights there?
They mentioned a new energy-efficient electric diaphragm pump and an AeroProtect service solution to, again, boost that recurring revenue.
Okay, got the picture on results, strategy, segments. Now, the reaction, this is where it gets really interesting.
Absolutely. Because despite all that positive management talk, the raised guidance, the market hammered the stock.
Hammered is right. It went from, $84.63 down to $74.98.
An 11.4% drop by the close. Even pre-market was signaling a nearly 7% fall.
Ouch. And the trading volume.
Huge. 12.2 million shares. That's like 4.7 times the average daily volume. Tells you conviction sellers were out in force.
Any other market signals? Options?
Yeah, the options market screamed bearish, significant widening of the put skew.
Meaning more demand, higher prices. For puts bets, the stock will fall.
Exactly. More than double the normal open interest in the $80 and $75 strikes. Clear bearish positioning. And look, year to date, stock's down 15%, while the broader industrial sector, the XLI, is up 6%. Big underperformance.
So what were the analysts, the sell side, saying?
Kind of split, actually. Some called it solid but fully priced, basically saying good quarter, but the stock's already expensive.
Valuation concerns.
Exactly. Others trimmed price targets because of that valuation. And the buy side, the big investors, they were talking about multiples, like 59 times trailing PE.
59. That's high for an industrial.
Very. And 11 times forward EBITDA. Even with the company's good margin story, those numbers were seen as a headwind. Some funds apparently rotated out into peers like Parker Hannifin.
Seen as maybe better value. Okay, so valuation is a key part of the disconnect. What else? Macro worries.
Definitely a factor. Management themselves mentioned a precautionary view on volume. The U.S. PMI dipped below 50 in July, remember? That signals contraction.
Right. Manufacturing slowdown.
And even though this company sees resilience in compressed air and life sciences, peers have been warning about China weakness. So there's that general caution.
And tariffs. Still an issue.
Seems so. Management thinks the uncertainty is causing customers to delay big projects. They're waiting for clarity, maybe new trade deals, maybe tax incentives.
So projects aren't getting canceled, just paused.
That's the message. They acknowledge it's slowing down the conversion of their marketing qualified leads, their MQLs.
Even though the leads themselves are up.
Yeah, MQL's up double digits, but they're moving slower through the funnel. Spec changes, maybe lack of engineering resources at the EPC firms managing the projects, bottlenecks, basically.
So looking forward, what could change this negative sentiment? Any catalysts?
There are a few potential ones. They have a capital markets day planned for November. They'll detail their digital services roadmap there.
Could provide more clarity on that recurring revenue strategy.
Exactly. More M&A, those 8 LOIs if they close some deals. That could boost growth towards the high end of guidance.
Tangible progress.
We also get the Caterpillar numbers in December, often a bellwether for industrial CapEx spending.
A broader market read-through.
And just, any macro improvement, an uptick in global PMI, especially China, where they surprisingly saw organic growth. That could give the stock some real upside torque after this sell-off.
Right. Lots to watch. Okay, now for our speculative segment. Completely not financial advice. Do your own research, all the usual caveats.
Absolutely. Purely a thought experiment. If we were pitching an outrageous but plausible idea...
How about this? The market reaction here seems overdone, right? An 11% drop despite raised guidance.
It does feel harsh. The punishment seems focused on that non-cash impairment and maybe general market jitters, maybe valuation. But the core M&A strategy seems to be working, generating growth, good returns.
So my wild idea. Consider a paired trade. Short the broader industrial sector, the XLI ETF, and go long this company.
Interesting. Explain the logic.
Well, the idea is the whole sector might face macro headwinds, hence shorting the XLI. But this company's specific issues, the impairment, the valuation reset, might be temporary or overblown.
Isolate the company-specific story from the general sector drag.
Exactly. The impairment is non-cash. There's an insurance claim. The life sciences bit is strong. The M&A engine keeps delivering. They're innovating with AI. They're finding demand pockets.
So the paired trade bets that general industrial weakness continues, or at least doesn't roar back, but this company's specific issues resolve, allowing it to outperform the sector.
Precisely. If Q3 sees those MQLs convert faster, or we get tariff clarity, or that November capital markets day impresses, the current bearishness could flip fast.
Especially since valuation was a key reason for the sell-off. Positive news could lead to a quick re-rating. It's a classic baby thrown out with the bathwater potential scenario, an opportunity for someone who thinks the market overreacted.
Again, purely hypothetical, but an interesting thought. Okay, so that wraps up our deep dive for today.
We've seen a company that sounds confident, is executing on M&A, raising guidance.
But the market reaction tells a different story, highlighting those concerns about valuation and the macro picture. It's a real disconnect.
And remember, the market narrative is always evolving. Knowledge is your best tool. Keep exploring these dynamics yourself.
Absolutely. Thanks for joining us on the deep dive. We really appreciate you trusting us to help you stay informed. Hopefully you got some of those aha moments.
Until next time.
Keep digging into the data.